And the Indian rupee is under pressure. It's something that's quietly shaping your everyday life. In recent days, the rupee slipped past the 95 mark against the US dollar for the first time ever. And this is not a one-time fall. The currency has logged an 11% decline in the previous financial year, which is its steepest fall since 2011-2012. Over the past 6 months, the rupee has fallen more than 5%, and in the past 1 year, the fall is around 10%. One of the biggest triggers behind the recent fall has been oil. Global crude oil prices have surged, with Brent crude hovering around $100 per barrel. In India, the commercial LPG rate has been hiked and the jet fuel price has doubled. But here is why it matters. India imports most of its oil, and oil is paid for in dollars. So, when oil becomes expensive, India needs more dollars to pay for it. And when demand for the dollar rises, the rupee weakens. It's economics. This is called demand and supply. At the same time, the US dollar itself has become stronger globally. You might hear the term dollar index. It's basically a measure of how strong the dollar is compared to other major currencies. Right now, it's nearing 100, which signals strength. In uncertain times, investors run towards the dollar because it's seen as a safe haven. And when money flows into the dollar, it naturally flows out of currencies like the rupee. Now, add geopolitics into the mix. The ongoing tensions in West Asia have made global investors nervous. And when that happens, they tend to pull money out of emerging markets like India and move it into safer assets. And that means more dollars being bought, more pressure on the rupee. Over the past year, foreign investors have pulled out massive amounts of money from Indian stocks. Over $19 billion. That's a huge outflow, and it directly impacts the currency. India's central bank, or the Reserve Bank of India, did step in with a surprising move, tightening forex position limits. In simple terms, it tried to control how much traders can bet on currency movements. This gave the rupee a breather, and it regained some ground.
The bottom line is that the RBI's cap does not change the underlying dynamics that fueled pressure on the currency. The rupee remains particularly vulnerable to an oil supply shock, while India's balance of payments position may deteriorate further, and capital and financial account pressures are increasing.
Now comes the real question. How does this affect you? Simply put, if you're planning to travel abroad, it's going to cost you more. If you're buying imported goods, you'll feel the pinch. The prices of everything over time will change. A falling rupee also feeds into inflation, making everyday life a little more expensive. But it's not all negative. Some sectors like IT and pharma actually benefit because they earn in dollars. When the rupee weakens, their earnings look stronger back home. So yes, the rupee's fall is worrisome. How the Reserve Bank of India navigates external challenges will shape the rupee's story going forward.